This is Optimal Finance Daily, episode 1065. Can Debt Be Your Friend? Part 1 by Harry Stout of FinancialVerse.com. And I am Dan, I'm your host, and this is where I read to you from some of the best blogs on personal finance, and I do that every single day, including weekends and holidays. And we actually have 5 different shows where we do that, but they all cover different topics, so you can search for Optimal Living Daily wherever you're hearing this to find all 5 of our narration-style podcasts. But for now, let's get right to our post from Harry Stout as we continue optimizing your life. Can Debt Be Your Friend? Part 1 by Harry Stout of FinancialVerse.com. In the last few months, we've seen reports that the U.S. government's outstanding debt has exceeded $22 trillion. Student loans now total over $1.6 trillion, and over 7 million people are over 90 days past due on repaying their car loans. Yeah, 90 days past due. When you read headlines like these, my mind starts racing to figure out if taking on personal debt is poisonous or if debt can be helpful to life. In the financial verse, it all depends on how you are going to use the debt. As a refresher, debt is money that you borrow from banks, family members, friends, and financial institutions, and is usually evidenced by you signing a written agreement or note explaining how you will repay the debt and under what terms you have borrowed the money. Debt has many forms, including credit cards, installment loans, student loans, mortgage loans, payday loans, and car loans, and each type of loan has different terms and costs. The cost for the debt you borrow is called interest expense. In addition to interest expense, you will sometimes give up an ownership interest in the property acquired, for instance with mortgage and car loans, until the loan is repaid, agree to repay the loan over certain time frames, for example 48 months, sign different legal agreements, and pay different rates of interest expense depending on the loan type. Interest expense varies based on the type of loan you use. The annual cost of the loan can range from single digits, perhaps 4% for a mortgage, to over 100%, yes, 100% annual interest for payday loans. You need to understand the manner in which interest is charged on the loans you take out. One way to understand the total cost of the money you're borrowing is to understand the annual percentage rate, or APR, of the loan. This percentage is required to be disclosed to you when taking out a loan based on state and federal truth in lending laws. The APR shows the full cost of the loan, including any fees you are paying the lender to get the loan. It is the best way to make sure you have the real cost of the loan to understand and compare. When should people use debt? In today's financial verse, people should only use debt to get cash to buy carefully considered, big-ticket, expensive things that they haven't paid for fully, or when funds are needed for important goals like college education, a home, or a vehicle used to get to work. In rare circumstances, people may need temporary funds to help absorb the costs of an unexpectedly large medical bill or other unexpected cost that exceeds their emergency fund. These types of borrowing make sense, provided you can repay the loans with your existing or future expected cash inflow, in the case of a college education. Contrast this type of borrowing with what we see today, where consumers use high-interest cost debt like credit cards, retail store cards, and payday loans to buy things they don't really need, pay regular monthly bills, or to maintain a lifestyle that they cannot afford in the long term. This type of debt, when added to the debt taken on for big-ticket purchases, is sapping the financial strength of households. It is forfeiting their financial futures to pay minimum monthly payments and high interest rates for years and years. How much house expense should you have? The largest monthly outflow for most people relates to their housing expense, either mortgage-related costs or rent. Here are 2 key considerations when determining if you are taking on too much housing cost. 1. You need to limit your total housing costs, including mortgage or rent payments, real estate taxes, and homeowners or renters insurance, to a range. Keeping housing costs under about a third of your income should leave plenty of money to cover other necessities like food, transportation, childcare, and insurance. 2. Borrow wisely. Defaulting on a mortgage, home equity loan, or home equity line of credit comes with the risk of losing your home. Most common types of debt. Let's look at the 4 most common types of debt you will encounter in the financial verse. Mortgage debt. Houses are generally the most expensive purchase most people will make in their journeys. To make this big-ticket purchase, many individuals need to secure a mortgage on the property being purchased. There are a few different mortgage types to consider, including Federal Housing Administration or FHA loans, veterans or VA loans, conventional loans, and home equity lines of credit. Each loan type has its own interest rates, amortization schedules, repayment terms, down payment requirements, and other requirements. Starting for the 2018 tax year, the interest paid on a home equity loan will only be deductible if the related loan is used to buy, build, or improve the home securing the loan, subject to certain limitations. Student loans. Hear that in tomorrow's episode. You just listened to part 1 of the post titled, Can Debt Be Your Friend? By Harry Stout of FinancialVerse.com, and I will finish the rest of this post for you tomorrow. That's going to do it for today. Hope you have a great rest of your day and a terrific weekend if you're listening in real time, and I'll see you back here for the Sunday show tomorrow, where we will finish up this post and where your optimal life awaits.